In this video, we'll complete our financial accounting review. Our focus in this video will be on reporting. The second part of the practice set requires you to present a multi-step income statement, a statement of retained earnings, and a classified balance sheet. In addition to that, you're going to compute some cash flow numbers. We're going to take accrual basis numbers and convert them to cash. You're given an adjusted trial balance for this part of your practice. The first thing you're going to do is prepare a multi-step income statement. If you recall, a multi-step income statement includes several subtotals. The first one is gross profit. The second one is operating income. The third one is income before taxes, and then net income. Gross profit is also known as gross margin and is computed as net sales minus cost of goods sold. Gross margin minus your operating expenses gives you operating income or income from operations. Then you're going to add in other revenues and gains, subtract out other expenses and losses before coming down to net income or income before taxes. And then you'll subtract out taxes to get to net income. So the basic format of a multi-step income statement is just that. Net sales minus cost of goods sold is gross profit, minus operating expenses is operating income, add other revenues and gains, subtract other expenses and losses to come down to income before tax, subtract out income tax expense to compute net income. So reviewing some of these amounts. First of all, operating expenses. Operating expenses are general, administrative, and selling expenses that are incurred in connection with the company's primary operations, bearing in mind that BRI is an online jewelry retailer. So the cost of the jewelry that they're selling would be recorded as cost of goods sold. It's not in the operating expense section, but operating expenses might include rent expense, depreciation expense, amortization expense, utilities expense, and other expenses incurred in connection with their primary operations. We want to distinguish between operating items and non-operating items. Non-operating items are either going to be reported as other revenues and gains or other expenses and losses. These are transactions that are peripheral to the primary operations. So other revenues and gains would include sales on assets other than inventory, unrealized holding gains, interest income, investment income, rent revenue, and dividend revenue. Other expenses and losses would include losses on the sale of assets other than inventory, unrealized holding losses, interest expense, and impairment losses. On your multi-step income statement, you're also going to be reporting earnings per share, both basic and diluted. Basic EPS is net income minus preferred dividends divided by the weighted average common shares outstanding. Preferred dividends have a preferential right to dividends, meaning that they're going to receive dividends before the common shareholders do. Some companies don't have preferred stock, so we want to look at our adjusted trial balance, and we can see that we do have preferred stock outstanding in addition to the common stock. The preferred stock is 5% $100 par preferred stock, which means that the preferred shareholders are entitled to a dividend that's equal to 5% of $100 each year. So we're going to take net income, and essentially what we want is net income available to the common shareholders. So you're going to subtract out those preferred dividends and divide by the weighted average common shares outstanding. To get weighted average common shares outstanding, we're going to take the common stock balance of 400,000. We're going to divide it by the $10 par, and that's going to tell us how many shares were outstanding at the end of the year. We're just going to use that number for weighted average common shares outstanding. So basic EPS is net income minus preferred dividends divided by your common shares outstanding. Diluted EPS takes into account whether or not there are any potentially dilutive securities. Potentially dilutive securities include things like convertible convertible preferred stock, and convertible bonds. If you recall, we had a bond that was convertible to shares of stock, so that is going to be a potentially dilutive security. So when you have a convertible bond, you're going to increase your numerator by the interest savings net of tax and increase the denominator by the additional shares that would be issued. So the way this works is that those convertible bonds, this is the second year that they've been outstanding. Had they been converted, we would have saved the interest expense. So you're going to calculate the interest expense that we would have saved from the beginning of the year to the end of the year. We're going to be adjusting net income, which is a net of tax number, so you also need to adjust the interest savings for the tax effect. The assumption is that the bonds would have been converted at the beginning of the year, so we're saving the interest expense. So you're going to add the number of shares that would be issued to the denominator. So you can calculate diluted EPS, compare it to the basic EPS, and you're only going to report it if the effect is dilutive. This means that diluted EPS is lower than basic EPS. We're not doing a comprehensive income statement in this problem because we don't have any OCI numbers, but we need to review this concept. You should have reviewed the concept in the conceptual framework chapter, so hopefully this is familiar. Comprehensive income is equal to net income plus or minus other comprehensive income. Once again, we're adding a number to net income. Net income is net of tax, so we need to take into account the tax effect on your other comprehensive income or OCI items. So examples of other comprehensive income items include unrealized holding gains and losses on AFS debt securities, foreign currency translation adjustments, unrealized gains and losses on cash flow hedges, prior service costs on defined benefit pension plans. So the one of those with which you should be familiar is the first one, unrealized holding gains or losses on AFS debt securities. If it's an unrealized holding gain, we would add it in. If it's an unrealized holding loss, we would subtract it out. So net income may be more or less than comprehensive income. Next, we're going to prepare a statement of retained earnings. Keep in mind that the amount of retained earnings reported on your adjusted trial balance is the beginning of the year, or the 12/31/2022 balance. We haven't closed the books yet, so that amount has not been adjusted for net income and dividends. On our statement of retained earnings, the basic format is to add net income and subtract dividends. We might put together a more complicated statement of retained earnings, which could include other items such as adjustments for cumulative effect of a change in accounting principle or correction of an error. Next, we're going to move on to our classified balance sheet. Your basic format of a balance sheet is assets equal liabilities plus equity. But in our classified balance sheet, we're going to come up with subcategories for the balance sheet. In the assets section, you're going to have current assets, investments, PP&E, intangibles, and other non-current assets. Not every company is going to have every category, but most companies would at least have current assets and PP&E. Your current assets should be listed in order of liquidity, so cash is going to be listed first. One of the things we want to think about as we put together our classified balance sheet is what is reported for the various assets and liabilities. So your marketable securities or short-term investments, these could be trading debt securities, or they could be a portfolio of equity securities that you're planning on selling within the next year. And we're going to use the fair value method and report those securities at fair value. The note receivable balance that you report is going to be the face amount of the note, and the interest receivable would be reported separately. Accounts receivable are going to be reported at the amount expected to be collected, or the balance in accounts receivable minus your allowance for doubtful accounts, which is the estimate of what you don't expect to collect. Inventory generally is going to be reported at lower of cost or net realizable value, and then prepaid expenses are going to be included at cost. We want to remember for all assets, cost is all cost incurred to get the asset ready for its intended use. So for marketable securities, the initial cost would include any commissions that you paid. For inventory, it would be your cost of your inventory plus any freight in that you paid minus any discounts that you took. The next category is investments. Included in the investments category would be HTM bonds, which would be reported at amortized cost. If we have an equity investment that's greater than 20%, we're typically going to use the equity method and report them at cost adjusted using the equity method, which means we're going to increase it by our share of their income, decrease it by our share of the dividends. If a company has subsidiaries, meaning they have an investment in a company that's greater than 50%, typically that is also going to be reported at cost adjusted using the equity method. Notes receivable, which are due after 1 year, are going to be reported at the amount expected to be collected, and in your investment section, assets held for future use, such as land that you purchase for future use, is going to be recorded at cost. If you bought land for speculative purposes, meaning that you bought it with the plan of selling it at a higher price in the future, that would also be reported at cost. In the PP&E section, we're going to include our land, our buildings, and our equipment. This is also going to include any leased assets. Land in use is going to be reported at cost. Buildings are going to be reported at cost less accumulated depreciation, otherwise known as the book value. Equipment is also going to be reported at cost less accumulated depreciation, or book value. So for a building, cost is going to be the purchase price of the building plus any commissions paid. For the equipment, it would include the freight that you paid to acquire the equipment and any other costs you incurred to get the asset ready for its intended use. So we do want to note that all of these assets are subject to impairment testing. If there's an impairment loss on the land, it's going to decrease the land account directly, and if we have a impairment loss on building or equipment, it would increase the accumulated depreciation account. Our next category is intangible assets. Limited life intangibles include things like patents, customer list, production backlogs, some licenses, and franchises, and these assets are going to be reported at cost less amortization and impairment losses. Unlimited life intangible assets include goodwill, trademarks, trade names, newspaper mastheads, internet domain names, some licenses and franchises. and these are going to be reported at cost less impairment losses. In some cases, you might have a final category, other non-current assets. This could include assets held for sale that are not expected to be sold in the next year, and these assets are reported at net realizable value, which is fair value minus expected cost to sell. Deferred tax assets are also reported as long-term assets. They can be reported in the other non-current assets section. In some cases, we write down deferred tax assets, and if we do that, it would be reported net of that allowance. Liabilities are going to be classified as either current or long-term. They're current if they're going to be paid within 12 months of the balance sheet date. They're long-term if they're going to be paid after that period. Current liabilities typically include accounts payable, notes payable, and other debt due within 1 year. Accrued payables such as interest, taxes, salaries and wages, and utilities, and the current portion of a lease liability. Long-term liabilities include the remaining portion of the lease liability, bonds payable and notes payable due beyond 1 year, and deferred tax liabilities. In the stockholders' equity section, you're going to have your paid-in capital section and your earned capital section. In the paid-in capital section, you would include your preferred stock and common stock accounts, as well as any additional paid-in capital accounts, including additional paid-in capital on treasury stock. Stock dividends distributable are also reported in the paid-in capital section. Retained earnings, or deficit, is the earned capital. In some cases, you might have accumulated other comprehensive income. We don't have that here, but bear in mind that accumulated OCI can either increase or decrease your stockholders' equity balance depending on whether it's cumulative gains or cumulative losses. Another item that might decrease your total stockholders' equity would be treasury stock. We use the cost method to account for treasury stock. The final step in the accounting cycle is closing entries. You don't have to do these entries, but we want to review them. Temporary accounts are accounts which are used during an accounting period to accumulate some type of activity. So revenues, expenses, and dividend accounts are examples of temporary accounts. They need to be closed at the end of each period so that they can be used in the next period. They need to have zero balances going into the subsequent accounting period. Permanent account balances are asset, liability, and equity accounts that are carried forward into the next period, so they are not closed. The steps are: close your revenue and expense accounts to income summary. Revenue accounts have credit balances, so they need to be debited. Expense accounts and loss accounts have debit balances, so they need to be credited. The offset is going to go to income summary. Assuming you're in a net income position, the balance in your income summary account after you close your revenue, gain, expense, and loss accounts to income summary should be your net income. Next, you're going to close income summary to retained earnings. That will have the effect of increasing retained earnings by net income or decreasing it by the net loss. And then finally, we're going to close the dividends account to retained earnings. So retained earnings will decrease by the dividends. The retained earnings balance after the closing process should be equal to the balance that you calculated on your statement of retained earnings. Hopefully you found this review helpful. If you have any questions, please shoot me an email.